All right, let's dive right into this. Welcome to the Explainer. Today, we're tackling an absolute essential when it comes to the stock market. Even if you've been trading for a while, refining your toolbox is really what separates the pros from everyone else. So today, we're opening up that toolbox and breaking down the absolutely crucial nuances of order types. 90%. Honestly, that number represents a massive trap. 90% of retail traders get order types completely wrong at some point. They just jump right in, super eager to execute a trade, but they gloss over this foundational step. And the result? You can literally lose money without even realizing how or why it happened, simply because the wrong instruction was sent to your broker. So you open up your brokerage app, you spot a great setup, and boom, you're hit with these options: market, limit, stop loss. It's totally natural to think they all basically do the same thing, right? But if you don't understand the actual mechanical differences behind these words, you are flying blind. Ignorance here isn't bliss, guys. It is a literal accidental money leak. But hey, don't worry, by the end of this explainer, you're going to know exactly which order to use and exactly when to use it.
Okay, let's establish a really simple baseline here. An order is nothing more than your specific instruction to your broker. It's just you raising your hand and saying, hey, I want to buy this stock or I want to sell this stock. That's it, the whole shebang. But the real key to mastering your trading toolbox is understanding that there are very different ways to actually give that instruction.
To put that into perspective, think of it exactly like ordering at a fast food joint. On one hand, you could walk up to the counter and say, give me whatever's available right now. You get your food immediately, whatever it happens to be. On the other hand, you could say, you know what, I'll wait until the burger is exactly $5 before I buy it. Both methods eventually get you fed, sure, but the process and the final outcome are totally different. It is the exact same thing with stocks. Different orders equal completely different outcomes.
Section 1. Market versus limit orders.
First up, we have the market order. This is the most common order, and it's literally the simplest one on your app. When you place a market order, you're sending a very loud, very clear message to your broker. Buy this stock right now at whatever the current price is. It's like walking into a store, grabbing an item off the shelf, and just saying, I'll take this, whatever the price tag says at the register. Let's break down the actual mechanics of this. The pros are pretty obvious. It's the simplest order type, you get immediate execution, and there is absolutely no waiting or negotiating. You're either in or you're out. So when is this useful? Well, when you need to move fast. If the market is rallying hard or crashing and you just need to execute the trade immediately, this is for sure your tool. But the cons? Highly unpredictable price execution. If the market is moving really quickly, the price you see on your screen when you hit buy might not actually be the exact price you end up getting. You're basically trading price control for pure speed. Now, let's look at the exact opposite, the limit order. If the market order is for the impatient trader, the limit order is for the patient, calculating trader. When you use this tool, you're telling your broker, listen, I will only buy or sell at this specific price or better, not a penny worse. So the crucial takeaway here is that you gain total control. Let's say a stock is at $100 right now, but you think it's overvalued and it's going to drop to 95. You set your limit order at 95. That order just sits there like a trap waiting to be sprung, and it will only execute if the price actually hits $95. The upside? Perfect price control. The downside? Well, the price might never hit your limit. The stock might drop to $96, reverse, and absolutely skyrocket, and you just miss the trade entirely. Market orders mean right now. Limit orders mean only at this price. Section 2. The safety nets, stop loss, and stop limit. I really cannot stress this enough. This next order is the one that can literally save your entire account, the stop loss. I want you to think of this as your emergency exit door. It is an absolute necessity. You set a specific price, and if the stock drops down to that dreaded number, your order automatically converts into a market order and sells your position to get you out of the burning building. Let's actually walk through the math step by step so you can see the real power of this. Step 1. You buy a stock at $100. Step 2. You immediately set a stop loss at $95. Step 3. The market turns against you and the stock drops to 95. Boom, your broker automatically sells it. Why is this so amazing? Because you limited your loss to just $5 a share. Without that stop loss in place, you could have fallen asleep, held that stock all the way down to $50, and lost half your money. The stop loss is not optional, folks. It is pure survival. Now, there is an upgrade to this called the stop limit order. It's kind of like your smart exit. It actually combines two specific price points instead of just one. You have a stop price, which acts as the trigger to wake the order up, and you have a limit price, which is the absolute lowest price you are actually willing to accept for your shares. Let's see how this builds on our last example.
Step 1. Stock is at $100. Step 2. You set your stop trigger at $95, but you set your limit price at $94.50. Step 3. The stock drops to $95, so the order wakes up. But, and this is key, it will only sell between $94.50 and $95. The big benefit here is you control your minimum price, meaning you won't get a terrible fill if the market is glitching out. The massive risk, though, if the stock crashes so fast that it blows right past $94.50 before your order fills, your order just sits there, and you are left holding the bag as it drops to $80, $70, or worse. It's way more precise, sure, but definitely less reliable than a standard stop loss.
Okay, let's bring it all together into a quick cheat sheet you can use right now. If your goal is to get in fast and you just want the stock immediately, use a market order. If your goal is to buy at a very specific, carefully calculated price and you're willing to wait for it, use a limit order. And if your goal is to protect your hard-earned money from a market crash, always use a stop loss. Really, if you take absolutely nothing else away from this explainer, please remember that the stop loss is your ultimate safety net.
So you've seen the tools, the pros, the cons, and the traps that catch 90% of retail traders. But here is a final provocative thought to leave you with. Now that you know exactly how these manual orders work, how do you think high-frequency algorithmic trading bots exploit these exact same safety nets to trigger massive market liquidations? It's something to think about. Protect your capital, trade smart, and we'll see you next time on The Explainer.